Good morning, Ms. Lee and my fellow classmates. Today we're going to be discussing why does capital structure matter. So my group comprises of myself, Shanice Mwapela, and Shaila Kumar. So I'm going to start off by handing over the slides to Shaila. Thank you.
Thank you, Shanice. So we're going to start off with Task 1. Task 1 is an article written by Michael Milken in 2009 titled Why Capital Structure Matters. It means the entry of capital markets has continuously grown. Corporate leaders have to focus on 5 important factors when it comes to capital structure. The first, social trends, the firm and its management, government rules, the condition of capital markets, and the economy and dynamics of the industry. Most companies avoided defaults when they use capital markets to deleverage by paying securities at a lower price. For example, the company Johnson Controls used the proceeds from issuance to deleverage by paying off debt. The stock prices started to increase, but credit risk declined. The value of repurchased stock decreased by 50% when firms bought back the stock before market fall. When it comes to loans, any loans relating to real estate is good because property values always increase. Task 2. What is a capital structure? It is a way a firm finances its growth and operations using different funds. It's important to understand the theories of capital structure through the assumption of perfect and imperfect market. The theory, Modigliani theory, states that a perfect capital market is where firms and investors trade at competitive market price that is equivalent to the present value of future cash flows. There is no issuance cost or tax relating to security trading, and financing decisions of the firm do not change if investors with investments generated cash flows. MM1 talks about the firm's total value equaling to the market value of generated cash flows, and MM2 is the levered equity cost is equivalent to the unlevered equity. MM1, according to this graph, it shows that a firm's total value equals to the market value of the generated cash flows of its assets, and it's not stirred by the capital structure. The figure shows that if the investors choose a different capital structure from the one chosen by the firm, it will still be irrelevant as investors can lend and borrow on their own to achieve similar results. The figure shows that a large use of debt financing is exactly balanced by the increase of equity costs, which is why the WACC doesn't change. MM2 states that unlevered equity is equivalent to D. MM2 states that levered equity is equivalent to unlevered equity, with an addition of a premium that's corresponding to market value debt to equity ratio. This figure shows that when tax is introduced, debt financing is cheaper and it becomes dominant. The increase in gearing results to a decline in WACC and increases the company value in tax shield, which can be minimized if firms gear up to the highest level. Traditional theory is when there's an existence of optimal capital structure where WACC is minimized while the asset's market value is maximized. From the real world point of view, firms do not increase their debt to equity ratios to extreme levels because it is more likely for financial distress costs to lead to liquidation at high gearing levels. Therefore, debt and equity costs significantly rises at high gearing levels, resulting in an increase in the WACC. This is shown in the figure after this, showing the MM3, where the WACC increases. Trade-off theory talks about the balance between cost of finance, distress, the decrease in bankruptcy, and the agent cost and tax saving emerging from debt. This theory grew from the theorem, where the benefit of tax shield is compensated by the firm's agency and financial distress costs. This theory assumes that every source of finance has its own return and costs and are associated with organizations' earning capacity as well as insolvency of business risk. Pecking order theory does not take into account the optimal capital structure, but it considers information asymmetry and signaling effects. Firms maximize their value by selecting cheaper sources available to finance new investments. For example, if there's insufficient internal funds to finance investment opportunities, the firms may obtain external financing and choose the external finance source that minimizes asymmetric information additional costs. Next is task 3, which I'll be handing over to my fellow partner Shanice. Thank you.
And now we're going to be discussing task 3, which is effects of issuing new equity. Issuing new shares is actually part of equity financing. Companies use issuing new shares as a way of gaining extra equity capital. The result of issuing new shares is that it shows a decline in the capital share price. This is due to the low demand in the market due to the high number of shares in the market. And it also shows a negative signal to the shareholders. So the signals that it actually shows to the shareholders is that the stock has been overvalued in the market. And secondly, due to the decrease in the financial leverage, it actually indicates that management have no option but to seek external sources of funding. Thirdly, issuing of new shares is usually done when the price of the shares is at a high peak, and it shows that the management focused that there would not be any more increase in the share price. Thus, they decide to issue the new shares. And often, companies that are good are misjudged because when they issue shares in order to finance projects with positive NPVs, their shareholders and external investors might see this as a negative signal, and it may signal that they will need extra funds for the company instead of showing that they actually need it to finance the project. Now we're going to be talking about share repurchase. Share repurchase is when companies buy back their shares from the market. The reasons why they buy back their shares is because, first of all, it serves as a replacement for cash dividends. Secondly, the companies use repurchasing as a way of restructuring the capital structure, and they do this by increasing the equity and lowering the debt. And then lastly, it signals that the shares in the market are undervalued. These are a few examples of companies that have repurchased their stock in the past few years. So the first one is Glomac Berhad. It repurchased its shares on 28 September 2016, and it repurchased 10% of its issued share capital, which was equivalent to 72,782,131 shares. And before the repurchase, its share price was 76 cents, and after its repurchase, the share price was increased to 80 cents. And the second one is Potasco Berhad. It repurchased its shares on 3rd September 2014, and it also repurchased 10% of its issued share capital, which was 33,530,000 shares. Million shares. And before the repurchase, the share price was 1 ringgit 80 cents. And after the repurchase, the share price was still the same at 1 ringgit 80 cents. And the last one is Scientex. Scientex repurchased its shares on 22nd December 2015, it repurchased its shares of 1,886,800 shares. And before the repurchase, its share price was 4 ringgit 78 cents, and after the repurchase, the share price increased to 4 ringgit 93 cents. All these figures were obtained from Yahoo Finance and Bursa Malaysia. Thank you.